We have Vikram Taneja. He's head of AT&T Ventures today. We're going to dive into the topic of strategic investing. And before we dive into that topic, Vikram, maybe you can give our audience a little bit of context on your background and your experience at AT&T.
Yeah, happy to, and happy to be here. I've been with AT&T about 11 years. A lot of that was in sort of the corporate development tree. That was media and sports-related M&A, kind of when we had a broader sort of base of assets. We've always had a pretty strong investment portfolio. I'd say in the last 3 or 4 years, we started to hone that in and kind of corral it and relaunch AT&T Ventures. So that's what I've been up to the last couple of years. Prior to that, the time with AT&T was, various startups, a little bit of time in investment banking and venture capital, and so it kind of all came together over the last decade or so at AT&T.
And just to get a little bit of framework, how does AT&T differ in its corporate venture activities versus traditional venture capital and other corporate VCs?
Yeah, it's a good question, and there's probably a couple different distinctions, and maybe the first one I'll make is between corporate VCs and traditional VCs. So you think your Sequoias, Andreessens, that type of firm versus corporates. There's just inherently there's going to be more strategic focus on what the corporation is looking for when they make an investment. They may have some financial goals, but in all likelihood, they're looking more for strategic insights, things that are related to their business. Maybe they can advance product roadmaps. Maybe they're looking for new types of innovation in that category. So that will always play a part of the rationale between the two. I think what you'll see a lot of times with corporates and traditional VCs that there's sometimes complexity and deal structures. Maybe a corporate has to, they can't do safes, but they can do convertible notes. Maybe they won't lead rounds, or they won't go over certain valuation thresholds, whereas there tends to be a lot more flexibility on the traditional side. So as I think about it and how we position our venture product, if you will, it's that we aim to be very founder-friendly. We originated out of sort of an M&A mindset, so deal structures are not something we shy away from. We're happy to kind of engage in different types of equity offerings, recaps, bridge rounds, things like that. We're very comfortable with that. We also don't, when we're sort of leading around or in the middle of a deal, we don't do what a lot of corporates may do where you'll have sort of, I'll call them exotic terms. Maybe there's ROFRs or MFNs, things like that that are in some ways punitive to startups because they're just trying to get going, and restricting their business in certain ways can be a challenge for them to overcome. So we made a conscious effort when we started this again was that, we need to go in almost advocating for the founder in a lot of ways. And so that's kind of a unique part of my role is that I feel like I'm advocating for the portfolio companies inside of AT&T, but it ends up being a win-win because the company, the startup succeeds, and the benefit we're looking for from a strategic standpoint has a better chance of payoff.
And to dive in, maybe where are the areas you're prioritizing today? What is at the top of your list?
Yeah, it's a good question, and so we sort of look at the landscape when we look at what are areas we want to invest in as sort of does it make our network better, faster, more secure? That's going to be things like edge compute, cybersecurity, different types of AI, radio technologies. Or does it drive demand onto our network, right? So whether it's wireless or fiber, for 15 plus years, the primary driver has been smartphones, right? And we're past that cycle. AI brings a lot of new exciting categories into it, whether XR finally takes off or whether there's pull through from autonomous vehicles or robotics or new rulings with drones that'll allow more teleoperation. All of these are new categories that make me excited, but these are all kind of in this new realm of demand drivers for connectivity for us.
And among the many variety of technology trends today, and this telecom heritage of AT&T, how much do you have to keep oriented towards telecom, and how much can you venture out to other new technologies who are quite immature at this point?
Yeah. We will, it's kind of a mix, right? There's definitely a focus, and our network team is great and always kind of looking for new technologies to make routing more efficient, make our spectrum usage more efficient, or power consumption more efficient. So we're happy to invest in those technologies, but then kind of these more greenfield areas, right? Humanoid robots, like I've been looking at that a lot. We think that's a huge connectivity driver, and we're decades away, maybe not, depending on some of the recent announcements. But those are exciting, and we don't necessarily have a product roadmap to hit those categories right now, but we know that there's a need for connectivity, and it's something that we'll sort of evolve into, and so we'll place those bets also. We're happy to do that.
So when you mentioned humanoids, trigger of other new tech, IoT, 6G, which technology today would you say is the most overhyped, and which one is underappreciated?
Overhyped and underappreciated. I think I may put the broader bucket of physical AI, which I would have put robotics in there, as underappreciated. I think you get a lot of agentic AI. Maybe that goes in the overhyped, frankly, just the way that it's thrown around so much now. AI is real. Agentic AI will be real as it's implemented. But I think what a lot of people don't see yet is the next layer of this is how it influences your physical world, right? Whether that's autonomous driving, whether it's robots that are doing tasks around, whether it's drones that are delivering, food deliveries or packages. This is all starting to be available now. And I think one thing, as we think about even the network load, one of the reasons it's interesting to us is because when 5G was developed, it was with a lot of this in mind. And so you started to have networks start to emerge that didn't really have these use cases. It was just, can I stream my YouTube video, right? You could do that on 4G. But as you have more denser and more disparate, even in some ways, need for connections and connectivity, you start to see the demand for that next-gen network start to emerge. So those are probably what I would say for those.
And you describe being AT&T Ventures being very founder-friendly. What are some of the criteria for a startup? Is there some non-negotiable terms in order to be part of your portfolio?
Yeah. I think there's always sort of the filter of does it hit, does it make the network better or drive demand? So we'll always look at that. In terms of size and stage, we tend to be in kind of a Series A, B time frame when we make our first check. We'll go earlier or later, just depending on where we're at. We have some flexibility around that, so it's not a hard requirement. I think more than anything, as we start to do diligence and see, hey, do we have some kind of path to commercialization, or it's on a roadmap somewhere, as that starts to crystallize, we try to get to know the management team. I'm always interested in getting to know the founders, understanding what their passion is, why they're looking at this particular problem. And the more companies that we meet, you just realize how much they sacrifice of their personal life to get this company off the ground, whether it's time or relationships or energy or capital. It's just, there's got to be something bigger than I want to, build this widget. It's got to be something behind that. So it's just a lot of time that we spend with the management team to understand kind of, is this the right group of people to get this company to some kind of an outcome? And so if we feel good about that, that's probably, the gating item, right? Like, if we do, then we would potentially think about the rest of the things to invest. If not, then maybe it's not the right fit.
Okay, and in writing a check, there's a risk-reward kind of association with it. What is your metrics for determining success or not so successful investments?
Yeah, and some corporates will differ, and this is even an area going back to the traditional VC versus corporate VC area. Coming in at a Series A, B, usually there's some kind of product in market, there's some degree of fit, maybe there's revenue, maybe there's not, but you're de-risked from the very early seed stage investment where this company may not go anywhere. So we probably take fewer zeros in that sense, right? We're not deploying just at the seed stage. We're deploying dominantly in that A, B, C area. We'll take a few seed bets where they're really, strategically important and see where those materialize. And so that affects the financial, performance of what we look at in the metrics. So we're not trying to 10x every investment. Number one, we're looking for strategic insights. We're investing in categories where there's a product that we really like, it's in a category that we want to have more exposure to, and we want to either work with them on distribution or packaging our own solution in market, and then see where things kind of go from there. So that tends to be, further up the risk curve, but, it's something that we feel comfortable with at that point.
So there is not a fixed revenue level or customer count?
No. There are, I'm even thinking of the portfolio right now, we've got investments that are sort of the three guys in a garage type of situation where they've just got great tech, have no plan to commercialize it, but we know that it's really good tech and want to help them with that. We have others, like Databricks, right? They don't need us for anything on the investment side. They're doing great. And so you kind of have the spectrum of it. But like I said, usually they're in a kind of 10 to 20 million revenue, and they're looking for trying to scale the business.
We have a question from the audience here. And any thoughts on accelerated computing AI? And will it impact the development of future networking technologies, i.e. 6G?
It's a good question. This sort of computing or compute in the network is something that we think about a lot. And there's all kinds of companies, CoreWeave, Grok, Cerebras, that kind of bring this capability. And you think about, can you deploy this into an edge node and put that level of compute, like a GPU in the network, so that you can utilize it? Now, I'd say, the use case needs to be there for you to just go to GPT on your phone and send a query up into the cloud and get a response. That's probably sufficient. So what are the use cases then that are high bandwidth and super low latency? Low latency is sort of the marker of why you would need edge compute or GPUs at the edge. So now you're talking about use cases like autonomous driving. If I'm doing a lane change, I don't have time to go to AWS and come back. You need something faster. If I'm doing robotic surgery, right, remote patient monitoring, healthcare-related use cases, you need much more visibility and speed in your decision-making. And it's why in some cases, then there's like the third category is just on-device compute, right? Is it so fast, the need is so fast that I just need to do the processing and have the GPU in the device? Maybe, just depends on what the use case is. So I do think that now that we've moved past just smartphone world and you're starting to see more requirements, inference for AI in different applications is very compute heavy. And so those are the types of things that'll drive it. I do think that that's going to be a component of future networks, whether it's with 6G or 5G, frankly. I mean, you can do it with the existing infrastructure of the network at the radio level with new compute kind of around the edge. So it's how do you think about that? But I think that all these use cases are starting to emerge now. So kind of excited to see where that all goes.
And zooming out a little bit, maybe you can provide the audience a little bit of context on how hard or competitive it is for corporate VCs to go after the top tier investments. There seems in the public markets a significant concentration in technology investments.
Yeah.
Is that happening in the startup, in the private area, or are you seeing a broadening out?
There's definitely, I mean, venture is sort of known for signaling and club deals, right? It's, the markers of success, even before I was at AT&T at a smaller shop, you'd see, Kleiner Perkins would lead an A round, and that was good for them to raise through their Series C, because just because people saw them in the A, they would go and invest in them in the B or the C, and you'd kind of see where things go. So, I mean, the company still has to perform, but access to capital becomes easier. And what's happened over the last, call it 10, 15 years is the mega funds have started diversifying so much that, Andreessen, Sequoia, NEA, they all have sort of seed and scout funds. So they're deploying capital very early, picking their winners and then just doubling down over time. So it does leave not that much allocation available for others to come in. And so the fortunate thing for us is that we're not fighting with the non-mega funds for access to deals, right? If there's deals that are in the connectivity space, we're probably going to get asked or welcomed into those rounds. So it does make that easier in that if there's a company we were talking about earlier that was modernizing 911 infrastructure, sort of a cloud-native call handling platform for 911 centers that makes it much easier for when you call 911, you can enable your camera and pass that feed to first responders if you're in sort of a fire or something like that. And we like that category, but more importantly, that's something that we worked through our FirstNet teams with 911 centers. We knew that as this company was raising capital and we started to get interested in them, we would be able to have productive dialogue and add value as a corporate. So that makes it easier to get into those deals. I do think that kind of that middle level can get squeezed out at times and make it harder to get access, because now when you have a winner, everybody's taking their pro rata, if not more, and so there's just not enough available for others.
You've been head of AT&T Ventures for several years. Mm-hmm. What has been your impact in terms of driving this organization?
I think, we had a very large investment portfolio that was sort of disparate, I think was one thing. We had a legacy of just accumulation of investments and sort of organizing all of that, harvesting the ones that we knew we wanted to kind of make our core portfolio and positioning it for being back out in market as AT&T Ventures as a bit more branded than we had been in the past was important. We track deals that are happening kind of globally in our ecosystem and see who's doing what and are they interesting or not. And I think one measure of success that we have is really just the top of the funnel. Are we seeing everything? Are we getting access to all the right deals? And the last couple of years, our hit rate's been very good on that. We've at least seen all of them. Whether we've done them or not is different. But that's been a big piece, is just kind of getting back out there with this sort of dedicated effort. And then one thing that I think we're getting better at and working through is just sort of exposing this idea around innovation through startups internally into the company. One thing we've really benefited from, our product teams are very smart. They have great, biz dev folks and strategy folks that are kind of on the front lines with their respective industries. They see interesting companies, and they may have already been working with all of them and doing commercial deals with them and bringing them in, but we weren't necessarily sort of investing in them, right? They weren't being surfaced up to ventures to look at, evaluate for additional upside or additional opportunities where we can kind of take those relationships and move them into other product teams. And so we've done a better job of that, I think, internal to the company, of kind of raising that awareness and saying, hey, we welcome this type of innovation. We want to see more of these opportunities. And I think that's something that we'll continue to focus on, right? Just kind of driving home that point kind of with our respective product partners.
We're going to wrap up here on time. Just leave the audience maybe with your outlook on corporate VC investing. What do you see over the next 5 years? Okay.
I think, I forget around the time frame that we started to see it, maybe in sort of pre-pandemic, we started to see more corporates participate, right? And we track this stuff, so we look at it. I think the data is something like roughly a quarter of every venture deal that gets done has a corporate venture firm participating in it. That's pretty high compared to the 2000s. So I think what a lot of corporations realized is they get access to deals, they see revenue opportunities, we get really good technical and product diligence from our own teams. And so if you're able to find a way to bake that into your return profile and say, hey, a relationship with this company can really drive a lot of value, we should also participate in a round and try to catalyze their own growth because it's going to help both parties. I think most corporations have kind of become privy to that. They've realized that. And so there's not very many large Fortune 500s that don't have some degree of venture investing program. And I don't think that's going away. I think that'll continue to accelerate just because of the amount of data and insights you get from working with these companies day to day. It's I like to call it free diligence from our engineering team all the time, right? I rely on what they see. I rely on their insights in those respective industries. and then we kind of layer on our own investment analysis and make a decision based on that. I think it works out really well, and I think you're going to see that continue to grow.
Great. Thank you for the conversation.
Thank you. Appreciate it.